Hi everyone, I'm Anna. In the last video, we talked about Microsoft's development history, its business structure, and its competitive advantages. In this video, I'd like to first look at Microsoft's investment expenditures over the past few years and its future investment plans. Then, we'll analyze Microsoft's financial data to see if its current growth engines are strong enough, what potential risks exist, and finally, we'll assess what price would be a worthwhile investment. First, let's look at Microsoft's investment expenditures. This chart shows that Microsoft's capital expenditures have seen explosive growth, from $28.1 billion in fiscal year 2023 to $64.5 billion in fiscal year 2025, and reaching $83.1 billion in TTM, past 12 months, as of April 2026. According to Microsoft's latest financial report and publicly disclosed strategic plans, the main investment projects for fiscal year 2025-2026 are distributed in the following areas. Approximately $55 billion to $75 billion has been invested in cloud and AI infrastructure, including large-scale chip purchases and data center construction. Microsoft's official website discloses investments in multiple regions, including Canada, Germany, and the UK, all aimed at expanding its AI and cloud infrastructure. The second investment area is strategic investment in OpenAI, generally estimated at around $10,000. Other investment areas include the gaming ecosystem and network and security, with investments estimated at $5 billion to $10 billion. While Microsoft won't provide specific investment figures for the next few years, it will offer very clear directional signals regarding its investment focus. For example, capital expenditures will continue to grow to meet the needs of Azure and AI. Almost all Microsoft executives have repeatedly emphasized that AI is the top investment priority for the next few years. Global data centers will continue to expand to reduce latency, improve user experience, and meet the data management requirements of different countries. To address data center power issues, Microsoft will also invest hundreds of millions of dollars in green energy lock-in. Is Microsoft's massive $83.1 billion capital expenditure a ticket to the future or a bottomless pit? Let's look at the return on investment data from recent years. Based on the latest rolling 12-month TTM data as of April 2026, Microsoft current return on investment approximately 24.2%. While slightly lower than 37.35% in 2021, it still remains above 20%, despite a surge in capital expenditure to $83 billion, indicating that the early returns on its AI investments are very robust. If we only talk about this percentage, people might not have a good grasp of it. To understand what level Microsoft's 24.2% represents, we can look at the performance of other tech giants. Apple and NVIDIA boast incredibly high ROIs, while Microsoft and Google are at similar levels. Generally, an ROI greater than 20% indicates a company possesses a very strong competitive advantage. Microsoft has consistently maintained such a high ROI, suggesting its business model is highly capital efficient. Of course, these figures only represent past performance. In future financial reports, we will need to pay close attention to this data to determine whether Microsoft's high capital investment has generated correspondingly high profits. Next, let's take a look at Microsoft's financial data, focusing on 4 key aspects. Firstly, we are focusing on the growth of our cloud business, because Microsoft's major investments are primarily focused on AI. Here, cloud refers to Microsoft Cloud, a broader concept than the intelligent cloud segment. This is a consolidated statistical approach Microsoft established to showcase its overall cloud transformation achievements to Wall Street. It's not a single administrative division, but rather a cross-departmental revenue aggregation, including Azure, Office 365 Business, LinkedIn, Dynamics 365, and other cloud services. The latest data shows that the cloud business is growing at a rate of 25.05%, which is very high for a company with annual revenue of $189.7 billion. This indicates that Microsoft's cloud business is in a period of high-quality expansion. The second aspect we need to look at is Microsoft's profitability. The key metrics here are gross margin, operating margin, and net margin. The gross margin has remained stable, between 68% and 69% for a long time. Although Microsoft has recently invested tens of billions of dollars to purchase expensive NVIDIA chips and build data centers, its gross margin has hardly dropped. This shows that the revenue growth of Microsoft's new AI business has fully covered the huge hardware depreciation costs. Operating profit margin has steadily climbed from 41.59% in 2021 to the current 46.67%, demonstrating Microsoft's strong operating leverage. The marginal costs of software and cloud services are extremely low, and Microsoft possesses significant pricing power with enterprise customers, enabling it to absorb inflation and R&D costs through price increases or the introduction of high-priced products, such as Copilot. Net profit surged from $61.2 billion to $119.2 billion, with a staggering net profit margin of 39.04%. This means that for every $100 Microsoft earns, after deducting all costs, salaries, taxes, and R&D expenses, it retains nearly $40 in net profit. These figures demonstrate Microsoft's powerful earning ability and reveal that while expanding its scale, its profitability continues to evolve. The third aspect we look at is Microsoft's cash flow. Operating cash flow more than doubled, growing from $76.7 billion in 2021 to $160.5 billion in TTM, past 12 months. Operating cash flow is the purest indicator of a company's cash collection ability. The TTM growth rate of 27.81% demonstrates that Microsoft not only has high book profits, but also that it is actually collecting cash. This is primarily attributed to the prepaid model of Office 365 subscriptions and Azure cloud services. Although operating cash flow doubled, free cash flow only increased from $56.1 billion to $77.4 billion. The free cash flow growth rate for fiscal year 2025 is even negative 3.32%. The core reason, as you can probably guess, is the explosive increase in capital expenditures.
This indicates that Microsoft is using most of its profits to buy NVIDIA chips and build data centers. While free cash flow growth is slow, we can refer to its remaining commercial performance obligations, $625 billion. As long as order growth, 109%, significantly exceeds the rate of cash flow depletion, this temporary slowdown in free cash flow represents a healthy strategic investment. Currently, its $77.4 billion in free cash flow is still sufficient to support Microsoft's annual dividend payments of approximately $25 billion and stock buybacks of around $20 billion. This means that even during periods of aggressive investment, Microsoft still has the capacity to reward shareholders. The last aspect of the financial data is the balance sheet. The debt-to-equity ratio has been steadily declining, from 57.46% in 2021 to 41.25% by the end of 2025. Over the past 5 years, despite massive expenditures such as the acquisition of Activision Blizzard, Microsoft's asset growth rate has far outpaced its debt growth rate. Total assets more than doubled from $333.7 billion to $665.5 billion. This decline in the debt-to-equity ratio indicates an increasingly healthy financial structure for Microsoft. Cash saw a significant decrease of negative 32.10% in fiscal year 2024, but rebounded rapidly in fiscal year 2025 and TTM, past 12 months, growing by approximately 25%. The cash decrease in 2024 was primarily due to the $68.7 billion cash payment for the acquisition of Activision Blizzard. The rapid recovery of cash in 2025 and early 2026 demonstrates the strong cash-generating capabilities of Microsoft's core businesses. With a net cash balance of $31,855 million, Microsoft would have $31.8 billion in cash on hand, even if it immediately paid off all its total debt. Having reviewed Microsoft's key business growth, profitability, cash flow, and balance sheet, we have a very clear understanding of Microsoft's financial situation. Microsoft is a company undergoing a period of massive investment, yet still maintaining high profitability.
Even after the massive acquisition of Activision Blizzard and the AI arms race, its balance sheet remains rock solid. The debt-to-equity ratio has decreased from 57% to 41%, an extremely healthy sign. With total assets doubling in 4 years, Microsoft is transforming from a light asset software vendor into the world's largest owner of computing infrastructure. While Microsoft's financial performance is extremely strong, it also faces several deep-seated risks. As value investors, while appreciating the impressive data, it's crucial to pay close attention to the following gray rhino risks. The first risk is the return on investment risk of capital expenditures. The cash flow statement shows that Microsoft's capital expenditures are growing at an alarming rate, reaching approximately $83 billion in TTM, putting pressure on free cash flow, or FCF growth. The 10K report explicitly mentions that Microsoft is making preemptive investments in AI infrastructure. If the monetization of AI businesses, such as Copilot and Azure AI, cannot keep pace with the growth in depreciation and operating costs, Microsoft's operating margin may face downward pressure. Secondly, Microsoft devoted considerable space in its 10K filing to describing the global regulatory environment. While the acquisition of Activision Blizzard is complete, subsequent integration and future large-scale mergers and acquisitions, such as investments, acquisitions of AI startups, will face stricter scrutiny from the US, FTC, the EU, and the UK. The third risk is that while Microsoft's intelligent cloud is currently growing rapidly, its cloud gross margin has slightly declined from 72% to 67%. Microsoft is deeply tied to OpenAI. If OpenAI's leading position is challenged by other open-source models, such as Meta's Llama or competitors, Microsoft's first-mover advantage in AI applications will quickly disappear.
For the rest of today, we'll analyze whether Microsoft's current pricing is worthwhile. There isn't a single standard for judging whether a company's stock is reasonably priced. In the second episode, when we analyzed Amazon's stock valuation, we used the price-to-earnings ratio, PE ratio. In the fourth episode, when we analyzed NVIDIA's stock valuation, we used the discounted cash flow, DCF method. In this video, I want to use the PEG ratio to assess whether Microsoft's current stock price is reasonable. So what is PEG? Its formula is actually quite simple. Price-to-earnings ratio, PE ratio, divide by earnings growth rate, GGR, multiplied by 100. PE ratio represents the price you pay for every dollar of profit. Growth rate represents how fast this dollar of profit can grow in the future. If the calculated PEG ratio is less than 1, it indicates that the current price is undervalued. A PEG ratio between 1 and 2 is considered reasonable, while a PEG greater than 2 indicates that the current price is overvalued. Of course, this is a rather general range. In actual evaluation, we also need to refer to a historical range for the company. The growth rate, G, in the formula is a highly subjective variable. Some people use the growth rate over the past 12 months, which is the most objective. But investment is about the future, and a good past doesn't guarantee a good future. Others predict the growth rate over the next 1 to 3 years, which is the mainstream approach. But everyone's expectations for how much money Microsoft's AI business can make are different, which also leads to differences in the evaluation results. Today, we use the latter method, which is to first predict the growth rate for the next few years and then calculate the PEG ratio based on that growth rate.
According to the latest April 2026 consensus data from Wall Street analysts, top institutions predict the following EPS, earnings per share growth rate for Microsoft over the next 3 years. The annualized average growth rate, consensus CAGR, for EPS over the next 3 years is expected to be between 13.1% and 18.9%. Fiscal year 2026, projected growth of approximately 20.7%, adjusted EPS forecast of approximately $16.46. Fiscal year 2027, the growth trend is expected to remain around 15% to 18%. Fiscal year 2028, long-term growth is expected to be around 13%, a steady increase. Currently, Microsoft's PE ratio is 24. If we take a conservative estimate and assume an annualized EPS growth rate of 13%, the calculated PE ratio is 1.85. If we take an optimistic estimate and assume an annualized EPS growth rate of 19%, the calculated PE ratio is 1.27. Let's look at the estimates from other institutions. The most optimistic estimate comes from Full Ratio, which gives a PE of 0.81. This is calculated based on short-term EPS growth rates. Other institutions give estimates between 1.3 and 1.8, which is close to our assessment. Now, let's look at Microsoft's PEG level over the past few years. I found data from two institutions. According to Yahoo Finance, the PEG level over the past 2 years has generally been greater than 1.7. According to Zacks data, it is currently at its lowest level in the past 5 years. Before investing in a company, we can't look at the PEG ratio in isolation. We need to consider its overall financial health. There are several blind spots to the PEG ratio that we need to be aware of. One is the growth rate in the formula. We need to clarify whether this growth rate is driven by cost-cutting in R&D or by innovative products. Secondly, if our calculated PEG is low, but the company's debt is high, this is also very risky. Furthermore, some companies are in an investment phase. In the short term, for example, increasing spending to buy chips might temporarily slow EPS growth, making the PEG appear high. However, these investments are actually the foundation for explosive growth in the coming years. To summarize our analysis, if you believe that AI will bring a deeper efficiency revolution in 2027-2028, with actual EPS growth exceeding 18% over the next 3 years, then Microsoft's current stock price is absolutely undervalued. That's all for today's video. In the next video, I'd like to discuss Meta. Meta is a leading global internet technology company that started with social media and is now fully transforming into AI plus virtual reality, Metaverse. If you're also interested in this company, or if there are any other companies you'd like to learn more about, please let me know in the comments. See you next time.